Hello, everyone, and welcome to the Q&A session for 8/23 of 2023. Um, I have been away for a few weeks and haven't been able to record any of these or do any of these live just because I had a little bit of busyness, and I know that you guys asked in the forums at etradingedge.com for me to get these back going again. So I definitely appreciate that feedback, and here we are. So today we're going to be talking about quantitative easing. Where is it? What's been kind of going on, and this kind of shadow quantitative easing that's been happening in the background. And let's dig right into it. And before we do, let me just check a couple technical things here. Perfect. Okay, looks like we're doing great. And let me dig right into it. Okay, so where are we at as far as um, quantitative easing? What is it, and what has been going on lately with the markets? So that's a kind of a general question as far as what we're going to talk about here, and I am going to kind of hopefully clean this up just a little bit, and I'm going to talk about a few sections. So rewinding all the way back to 2008. Back here we've got two lines on this graph, and the two lines are, we have the S&P 500 back here in blue, and we have the Fed balance sheet in purple. Now, most people refer to the quantitative easing or the growing of the Fed balance sheet as think about like buying mortgage-backed securities. They're basically a new buyer coming into the system, and as they buy risk assets, right? As they buy risk assets, what ends up going on is that they basically change risk premiums in the market, and it allows for prices to go up across the curve as far as risk assets go. Now, digging in even further into this, we can see that in general, whenever we have time periods of growing Fed balance sheet, we have a growing market. Growing Fed balance sheet, growing market, right? And then this gets pretty aggressive over here when the Fed really starts to grow its balance sheet, right? You've got growing Fed balance sheet and you've got a growing market. Then, of course, when the Fed balance sheet goes stable back here, you can see that in general, the market starts to struggle a little bit more. Then what happened in 2016 was we ended up electing, in the US, we ended up electing a president that ended up giving a lot of tax breaks to companies, and that ended up ballooning their cash flows and all sorts of different things, right? So that ended up pushing stocks a little bit higher and inevitably turning into the Armageddon bubble or Volmageddon bubble before quantitative tightening took over again. But you can see here, you still can't fight with quantitative tightening. The volatility in assets picked up. The market started to push down, especially in late 2018, and then inevitably climbs all the way up when as a recovery in 2019, and then we really balloon up before COVID happens as not QE kicks in, right? Now, then we ended up actually starting up QE again, growing the Fed's balance sheet. And I'm just giving you a play-by-play of kind of how it's been going as the timeline grows, as you can kind of see the effect on risk assets, right? And then as soon as the Fed starts to slow down their growth and their balance sheet, you can see that stocks tend to struggle. So what's been happening over here? Why has the market been able to go up while the Fed has actually been reducing their balance sheet? And it's because they are reducing their balance sheet, but there is another system in play that is pushing money back into the market. And that system is this system. It's called the reverse repo facility. Now, the reverse repo facility is basically, think about it like a piggy bank, right? I'm going to cruise over here to this screen, so share this tab instead. So this is the reverse repo facility, and basically its offering is 5.3%. So basically what you can do is you can park your money. If you're a bank, you can park your money at this reverse repo facility, and you'll get a 5.3% yield on your money. Now, what's nice about that is you can park it, for a 5.3% yield on your money, and then you can, savings accounts and various things you can yield at like 1% or 2% or something like that. You make this 3% spread on your money, and you're nice and profitable from that, right? So there's a reason why you want to kind of do this, because there's a spread. Now, going further, you can see here that it ballooned pretty extravagantly in May of 2021, and I'm going to overlay stocks on this to kind of see where it goes where it goes up and how it kind of affects stocks and things like that. Now, if we go over to what the current offering is for the repo facility, the current offering is 5.25. So that means anything at 5.3, which is what the reverse repo facility is, if the target rate, if the bond market tries to climb above 5.25, which is what their Fed's target rate, if it starts to go up too much and the buyers aren't there for that debt, the reverse repo market, the money that's sitting in the reverse repo market from the banks, will naturally not put it at the reverse repo market. They'll put it into the bond market. And why will they do that? Well, you're getting better yield out of the bond market overnight than you are doing it in the reverse repo facility. So why would you park it at the reverse repo facility if you could do it over here at the bond market? And so that's what you do. So that's why we've been seeing some draining from the Fed repo facility. So the reverse repo facility. So let me pull this over here. So what happens when this happens? Ooh, let me finish that. All right. So we can see here that back in right about March or so, this is when it started to build up, 2021. The Fed was still growing their balance sheet. This is still very bullish for stocks, right? All the things like that. But back here in the background, there was excess capital that needed to be parked at this reverse repo facility. And ironically, when you start to put excess capital back here, you're not really, even though there is this growing of this balance sheet back there, it's being funneled and put into this reverse repo facility. So it's kind of like a snake eating itself, right? As it's pushing money out, it's being pushed right back into the back door, into the reverse repo facility. Now, this does something to risk assets that we don't see as much in the S&P 500. So if I pull out something like small caps, which are a higher risk asset, you can see that right when the reverse repo facility started to grow, even though it's coming out of the Fed balance sheet, right, you can see that in general, small caps started to struggle, right? Then, as we start quantitative tightening, or quantitative not QE basically, and kind of go the other direction, small caps and large caps started to really struggle as the reverse repo facility still continued to grow, right? So money's being drained out of risk assets very quickly during this time. This is why this retracement, or this correction, was so aggressive. Yes, we talked about this back in December of 2021, and I know there's some videos stamped back then that it was a really rough time. It was going to be challenging, and that we were going to go through basically a recession over the next year. But how deep and how much was basically created by this interaction between these financial assets, or these accounts back here at the Fed. Now that we went into the stable reverse repo facility, you can see that in general, it stabilized risk assets, right? But then what happens when you start to drain the reverse repo facility, and basically a new buyer comes in, right? As the new buyer in the reverse repo facility comes in, risk assets and risk start to go up, and you get this big push to the upside in stocks. So that's kind of what's been going on in the background here and what's kind of driving this. Now, if we really, really zoom in here, and I can just kind of erase all of these chicken scratches back here. All right, as you can see back here, the reverse repo facility, just as of July 20th, 2023, is starting to grow or at least stabilize right now. What has happened to risk assets during that time period? Yes, they've gone down and down. And the Fed is still tightening their balance sheet back here. If these forces continue, this is one of the largest buyer in the world of risk assets selling or not, or at least not buying right now, right? So you've got this big buyer that's been in the background here that's not there anymore, that's been really pushing stocks to the upside. So if this continues, or if the repo facility starts to grow again, we should see stocks continue to push down aggressively as this reverse repo market either grows or stabilizes. Now, if it stabilizes, we might be getting into like kind of a more choppy type of environment. But if it still contracts and the Fed back here still contracts, we will likely see this crater, because at the same time, my projections are that growth should also be slowing, and our Q over Q, quarter over quarter in the fourth quarter and the first quarter of next year are going to be negative. Or if they aren't negative, then they're going to be very, very, very barely positive. And that should also be a headwind to any type of risk assets that stocks. Now, that doesn't mean that we can't bounce and things like that, but the same net effect of draining on the reverse repo market and the Fed balance sheet kind of having to do this spur of the moment growth in their balance sheet, basically because some of the banks blew up, that is not there anymore. So there's a change in the macro environment in the background that is impacting risk assets. So we keep an eye on the overnight reverse repo facility, and if this starts to drop again, then we will likely see stocks grow and build. And if it starts to grow up again, we will likely see volatility and stocks go further south. And that is very typical with what we've been seeing here recently. And I don't know how much we can zoom in. I will see in just a second. Let's see here. The reverse repo facility does actually post, I believe it's every day here. You can zoom in quite a bit. So we get 22nd, 23rd, yeah. So every day we can see if they're growing or building. Now, there's a little bit of variance in it, so you can use some hysteresis or something like that to figure out if they're growing or shrinking. But basically, you can see that they've stabilized and are basically growing up, but they're not marching down, right? So as long as we're not marching down, likely the buyers, you can see here on an everyday basis, as long as we're not marching down and we're still stabilizing in the reverse repo facility over here, then likely the stocks will have a little bit harder time rallying, especially in a negative growth environment or a falling growth environment. Just to clarify on a couple things that get requested is the GDP Now estimates are very positive. So we can see over here in the GDP Now estimates that they're almost up at 6%. My readings are actually still below 4%, but we'll see what ends up actually finishing out for the quarter. But these are very, very, very positive. Likely they're not going to be that high. But if they are, that means that we do have positive GDP right now. So even with all of this positive GDP, we go look over at what's going on at the stock market, and even with that positive GDP from the beginning of this quarter, stocks have not been able to rise anymore. And that I really do believe comes down to this reverse repo facility growing and the Fed balance sheet still falling at the same time. That is a lot of money leaving the system and risk assets, and they'll react in kind, basically. So hopefully that answers the questions about kind of what's been going on in the background, and that QE has actually been happening, but just not in the same way, right? It hasn't been coming from the Fed balance sheet and from them starting a new system. It's actually that they built up this huge giant piggy bank back when they were doing an aggressive quantitative easing in 2021. And now they're able to use that big gigantic buffer without telling everyone that they're starting up quantitative easing. They're letting the system naturally buffer itself. And as that money drains back into the financial markets, it's actually stimulative. And we still have a long way to go, right? We went from 2.3 trillion to 1.7 trillion. So roughly speaking, 600 billion basically came out and into the markets. So we have, another, 1.7 trillion that can be drained out of this over time and put back into financial markets and stimulate them. If you project that out, if all of this money were to drain in, and you can see the impact that it had during this time period to have about 600 billion come in, probably a little bit more than 600 billion, 2.37 to 1.73, just a little bit more. But anyways, if that comes in as a new buyer, you can see how much of an impact that had to the stocks. So if we kind of project that going forward, I know that that's kind of like a rough and dirty way to do this, but basically we could probably say that we would likely see, let's just call it the S&P at least. If this were to fully drain down, we should see the S&P, this would probably be projected about right. So that would put the S&P up there at, up there at, let's see, 5210 or so, right? Just because of the money that was already parked back in the background as it kind of drained in. So that would be something that I don't think should surprise many of us if that were to happen again. Alrighty then. Of course, you guys can ask me anything if you're here live. If not, I'm going to wrap it up here. I know I had one recording right before this that ended up having some technical difficulties, so I'm going to go delete that. And this one should be the full one. Remember, I will be here just as you guys have requested at etradingedge.com in the forums. I will be here every week at about 2 o'clock to do a live Q&A. So you can always send me questions beforehand, or you can send me questions live right here in the YouTube chat, and we will take care of them. Anyways, you guys have a great week, have good trading, make lots of money, and safe travels if you are traveling like me this week. All right.